Hello everyone, my name is Vishaka Rajawat. Today I will explain you what is the financial ratios. So these are some outlines which topics we will cover. What are the financial ratios? Types of financial ratios, uses of financial ratio, liquidity ratio, asset management ratio, debt management ratio, profitability ratio, market value ratio, limitation of financial ratios, and one case study. So, what is a financial ratio? Financial ratio are created with the uses of numerical values taken from the financial statement to gain meaningful information about a company. So these numbers are found in the company's financial statement, just like a balance sheet, income statement, cash flow statement. These are the used to perform the quantitative analysis and the growth, margin, leverages, rate of interest, and the value, and the more. So where we can use this financial ratio. Firstly, it is used for the standardized the method of comparison. If we want to compare two years balance sheet, in that this financial ratio is help us. Industry analyze and benchmark. Every organization set up their benchmark yearly. So this financial ratio is a help out to understand the industrial how they can achieve the benchmark and how they can calculate it. This is also help in the stock market because and next is it is helpful for the planning and the performance of the organization. There are the five types of financial ratio. One is the liquidity, second is the asset management, third is the debt management ratio, fourth is the profitability ratio, and the fifth on the list is the market value ratio. Liquidity ratio. It is given an idea of the firm ability to meet a short-term obligation arising within a year. So we can consider that if we want a cash as soon as possible. In that scenario, we will use this liquidity ratio. There are the two different types of liquidity ratio. One is a quick current ratio, and another is a quick ratio. Current ratio indicate that the extending to which the current liabilities are converted by those current assets expected to be converted cash in a near to the future. So how we will calculate this current ratio? The current ratio is equals to current asset divided by the current liability. So we'll get the value of a current ratio. Next is a quick ratio. Quick ratio indicate the extent which the current liabilities are converted by those current assets which can be converted to the cash immediately. So, quick ratio, we can find out the quick ratio. There's a formula. The quick ratio is equals to current asset minus inventory divided by the current liability. So, we'll get the quick ratio. Next is the asset management ratio. It is an idea as how the effectively the firm can use its asset. So there are the four different types of asset management ratios, how we will find out. So first is the inventory turnover ratio. Inventory turnover ratio indicate that how many times the particular asset is a turn over the during the year. The faster the turnover is the better. So जितना जल्दी वो होगा उतने जल्दी अच्छे से हमारा turnover होगा. So how we can able to find out the inventory turnover ratio? So inventory turnover ratio is equals to sales divided by the inventory. Next is a fixed asset turnover ratio. Fixed turnover ratio indicate that how effectively the firm can able to use their fixed assets. So the fixed asset turnover ratio is equals to sales divided by net fixed asset. Next is total asset turnover ratio. It is a measure the total exact value of the assets. How much asset is there in the firm. So how we will calculate? So total asset to turnover ratio is equals to sales divided by total assets of the organization. So that we can find out the total turnover total asset turnover ratio. Day sales are outstanding. It is indicate the average length of the time of the firm must wait after the sales before it receive a cash. So the lesser the day, जितना कम दिन होगा उतना better होगा. So how we will calculate it? So the day sales outstanding is equals to account receivable divided by annual sales divided by 365. 365. The 365 is nothing but the total days in a year. Debt management ratio. It given an idea of how the firm has financed its asset as well as the finance the ability to repay the longer term debt. So there are the two different types. First is the total debt to the total asset. It is measured at the percentage of the fund provided by the creditors. So we'll calculate it by total debt to total asset is equals to total debt divided by total assets. Next is the times interest earning ratio. Time interest earning ratio measures the firm's ability to meet the annual interest payment. So so how we will calculate it? The time interest earning ratio is equals to EBIT divided by interest charge. Earning. Next is the profitability ratio. It is an idea. It's given an idea that how the profitable the firm is operating and utilize their assets. So first is the operating margin. So operating margin is equals to per rupees of the sales. So how much sales we are going on per rupees, it is indicate that. So how we will calculate it? Operating margin is equals to EBIT divided by sales. Profit margin. Profit margin help to find out the net income per rupees of the sales. We'll calculate it by net income divided by sales. Return on the total asset. It measured the ratio of a net income on a total asset. So return of a total asset is equals to net income divided by total asset. So next is the basic earning power ratio. It is indicate the ability of the firm assets to generate the operating income. So we'll calculate it. The basic earning power ratio is equals to EBIT divided by total assets. Return on equity. So return of equity, it is a measure the return of a common per shareholders investment. So we'll calculate it by dividing a net income from the common equity. Next is a market value ratio. It is given an idea to it is given an idea of what the investor think about the firm. It's a future prospect and it is also related the firm stock price and it is earn and a book value per share. They are the two types. One is a price earning ratio. So it indicates the rupees and the amount the investor are willing to pay per rupees or the current earning or the reported profits. So we'll calculate it by market price per share divided by earning per share. So next is the market or the book ratio. So it is indicate the investor regarding the company. So we'll calculate it market book ratio is equals to market price per share divided by book value per share. What are the limitation of the financial ratio? While the financial ratios they help us to evaluating the financial statement, it is difficult to evaluate a company by looking at the ratio. So we cannot only find out about more about the company by seeing their financial ratio, and it is also necessary to look the industrial averages and the comparison about the other companies, their benchmark companies, so that we can properly analyze about the company over the time. So the users of the financial ratios are also remember the limitation of using a ratios. They have to look beyond the number in the term of a qualitative factors like looking at the customer basic, the product portfolio, vendor, competitors, needs, investor, regulatory in R&D, changing in the laws and the regulations it is seen. So only with the basis of the financial ratio, we cannot judge any organization or the company to check more about the details or to finding more detail about the organization. It is very important to compare other factors also. So this is a case study. I mentioned two different years balance sheet. This is here you can check that I mentioned about the 31st December 2021, and the other one is the 31st December 2020. So we compare both the years balance sheet, and accordingly we prepare. So with the help of this balance sheet, we can able to find out all kind of financial ratios. Thank you so much.